Let's start with this. Let me set up the panel a little bit and talk about some of the key topics, and I'll have the panelists introduce themselves. So the concept of data-driven investing and portfolio theory. How many in the room are professional investors? You essentially make your money making investment decisions. You work with companies. So probably about I don't know, a fifth or so. So the different asset classes have traded with different compositions of human intervention, understanding, and then the use of data and technology to identify trends, patterns to make the decisions has evolved. In certain classes of securities, let's take credit derivatives or even now public securities, very, very high use of automation, computers, machine learning to essentially make investment decisions, and then humans will moderate and guide. But fundamentally, heavy, heavy dose of computer decisions. Venture capital, highly, highly human. Assisted by technology, assisted by computers, but very much human investment. And the panelists here on the team, I think, will have different experiences and different predictions, perhaps, and insights as to how this might change, what's right about it, what's wrong about it, and where this goes. So with that, let me start with, can you just do introductions for the benefit of the group?
Sure. Hi, my name is Jonathan. I'm one of the partners at Social Capital. I head up our data science and research activities. I started my career actually as a physicist. I did my PhD in theoretical physics at Stanford, and then went on to leave academia and went to a bunch of places and ended up at Facebook, where I spent several years building out data science and analytics for them before joining Social Capital, where my work really involves around making data useful for all of our activities. That includes helping portfolio companies get better with their data, getting them sort of one level better in terms of their fluency and their capabilities with modern sort of data science, and then using it for our activities as an investor to help us, make better investment decisions. And there are many different ways in which we use data. Portfolio theory is sort of one way, but there's many other ways, and I sort of cover that whole gamut of activities.
I'm Amar. I'm the co-founder and CEO of AiNgel. And at AiNgel, we use AI to find great startups and match them with their ideal VCs. We work a lot with VCs. We add value in three ways. The first is scaling their process of filtering inbound deal flow. Second is generating quality deal flow. And the third is analysis of their selection bias.
Hi, I'm Gerry Newman. I run New Venture Capital. I'm a venture investor out of New York City. I started venture investing about 20 years ago. 14 years ago, I stopped and started a company with a couple other people. And then I started again 9 years ago. So mainly seed enterprise software.
Excellent, thank you. So let's start with the topic of portfolio theory, with which you mentioned, Jonathan. The use of, so Gerry, you specifically have a blog post about power laws and venture capital returns, and you made some observations about what venture returns look like, what kinds of distributions they follow, and potentially what implications that has for professional investors. Can you just tell us a little bit about that, your conclusions based on your study of the research?
Sure. It was a long blog post, sorry. A few years ago, I decided to try to model my portfolio. Everybody models their portfolio in venture. I said, I'm going to use the power law. Everybody says it's a power law outcome, all the venture. And you try to model it with a power law, you're not going to get pretty far. I realized that even though everybody talks about power laws, nobody actually uses power laws to model their portfolio. So I decided to figure out how I could do that. And it was this 3-year rabbit hole, down the power law rabbit hole. It's interesting, the venture power law distributions are such that the more portfolio companies you add, the higher the expected value of your portfolio, which I don't know if that sounds weird to you, but usually with most probability distributions, the more you draw from it, the more likely you are to get the average, right? So if you have a normal distribution, the more times you pick from the normal distribution, the variance shrinks, the more likely you are to get the average. The average doesn't change. With power law distributions, in fact, the average increases. So what that says is if you're running a venture company, you should make as many picks as you can from that power law distribution. Your portfolio should be as large as possible, because then you have a higher expected outcome. Now, it grows pretty slowly. I wrote another post about it a couple days ago. It grows pretty slowly, and I think it's limited by two things. One, can you actually pick enough companies from a power law distribution? That is, can you pick enough companies that are venture companies, and can you manage them? And we all know that, if if I don't follow this advice. I invest in 5 companies a year. But if I invested in 10 companies a year, I would not be able to do the things I need to do to get those companies the next round financing to make sure that they're getting off the ground. There's a limit to how much I can do, and I feel like if I don't do that, then they won't be successful. So there's this tension between doing as many as you can and how many you can do.
Yeah, so at 500, I think we are practitioners of this large portfolio theory. The more bets you make, especially given I think what you observed about the venture returns, the returns can be better. There's a real constraint that we make 500 investments a year on average, so we are slightly more than 5. But then the amount of effort that it takes to manage the companies, track them, really understand where do you want to add value, double down is extremely complex. Jonathan, what do you think? Do you think that insight is right, that those are the outcomes of venture returns, and that a broad set of bets is the right way to go, or do you have a different view?
Yeah, I definitely think you can't argue with the math there. I mean, it's one of those things where I've read these analyses, this research myself, and have looked into this kind of stuff, and it's pretty clear that you need to make a whole lot of bets. Of course, the place where it fails is the stuff that you guys just mentioned, which is that the assumptions that build into this are the assumptions that you can sort of pick randomly from the distribution, which is of course not true, right? Like if you're a Sequoia, you do not pick randomly. You get to see everything, and if you are a small investor who's just starting out, you don't see everything, right? So your ability to pick from these distributions, in a uniform manner is not true. And the other piece of it, of course, is that we believe as venture investors that we can alter the outcome, reasonably so, right? Many of us have deep operating experience, and if we can bring that operating experience to bear in a situation where our experience is really well aligned with the company, then we can meaningfully modify the outcome of these companies. And I think how many people in here who are investors think that you have meaningfully impacted your company? Oh, hopefully a few of you. I see fewer hands than I would have hoped. Because if all you're doing is throwing darts, then that's not. I mean, not only not only is that kind of not great from a portfolio theory point of view, but maybe more importantly, that's not very fulfilling, sort of, in terms of how you spend your day. At least not for us. So I know we think a lot about how we can actually modify the outcome, how we can alter the outcome, affect it somehow, using our expertise, being in there with the company somehow to meaningfully change where on the distribution they lie.
So now the weird thing is that if that's true, if everybody's meaningfully impacting the outcome of their companies, then it can't be a random distribution, and it looks like a random distribution when you take the outcomes that are generated. So either the fact that you're doing the work creates the distribution itself, or it's the Lake Wobegon effect where everybody's helping but not really.
And then Amr, what do you think? So certainly access to broad portfolios and information is helpful. How should and you're a founder, and you're my favorite kind of founder. You're a 500 founder. How should VCs be thinking about being helpful to you, the founders? Are there ways that they can systematically spend their time better and be highly leveraged in adding value where it is the most meaningful?
Yeah, I think the value is really in kind of the experience that in the domain experience that we have, and also kind of just the kind of network effect of the VC. I mean, one of the benefits of being part of the 500 startups is really the volume. I mean, the kind of work that we're doing, just being around all of these other startups and having access to them and kind of testing some of our products with them, and obviously with you as well, that's a lot of added value. So it's kind of hard for me to generalize for all kinds of startups. But one point on the parallel distribution, I think the blog is really thoughtful, and you talk about the different alphas in terms of the different VCs having different alphas. So I think this is kind of key. What can VCs do to actually impact not just the outcomes of startups, but also their own alphas in terms of also the selection process. So it's not just the post-selection, but also in kind of the pre-selection. And this is where I believe data plays a big role in kind of lowering the alphas.
Yeah, I agree. I actually, in the first post, I said if you're an LP and you're trying to rate venture funds, looking for the highest outcome is probably not the right way, because somebody has one great outcome. It could be luck, it could be skill. If you actually try to figure out what the alpha of their distribution is, that's a better indicator of how good they are. If it's lower, then they're better.
So I think that's a great point. So maybe I'm returning to you. You've built a company that essentially you said helps VCs select companies and helps companies select the right VC for them. I think it's fair to say that a lot of venture capital firms are still highly human-driven in terms of their decision-making, relying on data, but essentially relying on individuals to make judgments as to where they want to invest and how much and where to follow on. Based on the data that you provided and the insights that you've gotten in discussion with the VCs, what do you think they are missing? Where does human bias tend to factor in? What are some of the variables that they're missing that you think they should be looking harder at?
Yeah, so we see two problems mainly. The first is kind of looking for these single attributes of successful founders. So actually this morning, I think you've heard Aiden talk about resilience. So from our data, actually, we see that resilience alone is not an attribute that's going to make you successful. Not statistically significant, but when you pair resilience with high self-awareness, now that is actually a statistically significant pair of attributes of founder success. Now, and you take this also, I guess, empathy was also brought up this morning, and empathy is interesting because what we found from data is that empathy alone is not a predictor of success. Empathy paired with other traits is actually very interesting and statistically significant. So empathy with high disagreeableness, which is interesting, that is a predictor of success. That's the profile of Amr Awadallah, for example, from Cloudera. When you look at empathy and high imagination, that's the profile of Reid Hoffman. That is a statistically significant success, a successful founder. And so that's kind of the first space. The other is kind of our analysis of bias with some of the VCs. We've clustered founder types into 8, and we found like type 2. We found like very diverse biases from one VC to the other. So it's not really very consistent. But what we've seen consistent in terms of types that VCs will usually miss on is one for type 2 is actually a first-time founder coming from a school, a good school, so it's not necessarily kind of the high-ranking Stanford, Harvard. It's a good school, and no corporate experience. They're very disagreeable, and they have very high self-efficacy, and very, very cautious, and not very gregarious. So they might not make the cut to be your best friend, but these are really good founders to invest in, and more VCs are passing on this kind of founder.
Excellent. So, what do we think? It sounds like, Amr, you've identified a couple of personality traits and a combination of personality profiles that would predict success that maybe is underrepresented. As you are thinking about picking founders and picking founding teams, are there certain attributes like that you think are quantifiable and could be captured through the collection of information and the analysis of information?
Well, there's clearly they are, right? I mean, I don't know if it's hard though with founders when they're first starting to collect much information. Obviously, you know where they went to school, but you don't. It's hard to know if they're going to be resilient or not.
Well, there are personality profiles that you can take, and there are the personality tests or types of aptitudes that you could probably incorporate and survey and process through some kind of algorithm, whether it's the combinations you're talking about, Amr, or other attributes that you could identify in personality tests?
We use public sources. So we use public sources, their digital footprint, to analyze their textual content, any videos that they've been in and speaking about their startup. But in general, it's kind of just understanding their digital footprint and their backgrounds, where they've worked before, if they had any startups before or not, where they went to school, of course. All of this is information that's kind of readily available. And then we start forming these team attributes. So it's not just about the founder alone. I could be a successful founder with a certain team and a lousy founder with another set.
Now, Jonathan, at Social Capital, you are experimenting with capital as a service, which maybe you can tell us a little bit more about, but it strikes me that you're pushing the extremes on identifying what works as far as a founder, a management team, a business, with very little human interaction or conversation, essentially using algorithms and data intelligence to predict success. What do you think? Is Amar right? Is this reducible to something you can analyze through patterns and data recognition, or is it too early to tell based on your capitalist as service beta?
Yeah, I think that the question of whether or not you can reduce the problem to this type of a problem is obviously yes, you can, but this goes back to the question of like whether or not you would choose to do so, and I think that's an important difference. So before I talk about capital as a service, I kind of want to give it an analogy. Can I give an analogy? Is that cool? Okay, so here's an analogy. Here's what venture capitalists do. It's kind of like you're a doctor, and there's a stream of 5-year-olds who walk in the door. 4 walk in every month, and your job is to pick the 5-year-old that will live to 100 years old. That's like patently a ridiculous thing to try to do. Now, you could try to. There's many ways you could approach this problem, right? If you tried to do this problem 100 years ago, you'd sit there and be like, oh well, everybody I've ever seen who lived to 100, they had blonde hair, so I'm going to pick people with blonde hair. Don't need data for that. Cool. Of course, like a modern doctor would not approach the problem this way. They would have a bank of machines. The machines would make measurements. The machines will not tell you which one is going to live to 100. That's not what medical sort of diagnosis, medical technology allows you to do, right? What it would allow you to do is identify things like, oh, this one has a predisposition to this disorder. It's not going to appear until they're 30 or 40, but doesn't look so good. Now, maybe things will change in the next 40 years. Maybe there will be some advancement that will render that problem sort of not a problem anymore. But for an investor to decide not to use data is kind of like choosing to enter into this type of game without using all of the benefits of sort of modern technology, right? So when I pose the question this way, I think it's important to pose this question this way because it renders the intractability of the problem clear. Right, it's not like there will be a formula. And when we talk about our capitalists, so a couple of weeks ago we announced a program that we're doing called Capital as a Service, in which we attempt to invest in companies without ever meeting them in person. We chat with them, or actually we don't chat with them. They go through a form, they send us some data, we look at the data, and we sort of have a bunch of ways in which we think about the data and we make a decision to act or not act based on that data. Now, are we going to hit home runs on every one of those companies? Well, I mean, that goes back to the question of picking 5-year-olds. Are we going to pick every 5-year-old who lives to 100? Obviously not, right? But in undergoing this process, so the thing is, in undergoing this, we're going to learn a bunch of stuff, one, and maybe two, more importantly, right? We have like a view of the world that we think it's better for the world if we choose in this way. If we, do not act as the doctor who merely chooses on hair color, or eye color or something ridiculous, that we will attempt to do this because we believe it's the right thing for the world, and in experimenting with it and learning how to do it, we can realize that view of the world while also hopefully, fully believe that we can make good investments on these things as we move forward.
So I think, just to add to that, I think even if we believe more in kind of the algorithmic, selection process, but it's also important to add that part of that is actually retraining the model, and in retraining the model, it's very important to actually select companies that the machine says no to, and so that's kind of a very important aspect of making sure that we're still seeing a pattern, and just making sure that the algorithms are modernized as part of the selection process. So I think that's important to add as well. It can be done, but it doesn't necessarily mean it's going to be the only way you perform. The other thing is just making sure that there's no bias built in kind of the selection itself. So for example, we don't include anything that has to do with gender, ethnicity, or anything like that. Now, there is kind of implicit bias when you start looking at, for example, schools. Yeah, so maybe founders outside of the US are going to be jotted down a few notches. But if you look at an example like Kareem, for example, so Kareem is the Uber of Middle East, on even that these founders were not kind of US based, they were outside, they still score very high on AiNgel in terms of predicted success. So I think there is kind of this balance in terms of the geography, where exactly are you implementing the algorithm in terms of geography, and potentially even industry.
Go ahead, Gerry.
So I am very aware that I'm old school. I teach a class at Columbia on entrepreneurship, and I tell the students that if there's something that I think is a really stupid idea, that's an opportunity for them, because that's, when I was young, I remember people telling me that there are things that couldn't be done, and those were usually the best things to do. So I hesitate to criticize the data-driven approach, but on the other hand, Aiden this morning said the next Google will not look like Google, the next Facebook will not look like Facebook. If you're drawing lines, you're going to end up with the wrong thing. I think there's a limitation to where the data can take you. Now, I think you can certainly rule out things. You can say, I have gotten business plans that were essentially perpetual motion machines, especially in the financial markets. I have an algorithm that will beat the stock market forever. All right. That can't be true, right? So you can rule some things out, but I think there's a huge space where you can't use data to actually predict what's going to work.
But are we talking about different? I mean, Google, the next Google doesn't look like Google, but this is kind of in terms of business and business model. But the question is, are they different types of founders? And if you have diversity in selecting the founders that can actually make it, then potentially you will capture them irrespective of what they're building.
It's hard because my data set's much smaller than the data sets you probably have. My founders don't look much like each other. A lot of them are relatively neurotic. They've got a chip on their shoulder, so maybe I look for neurosis, but it's or resilience. What do they call it nowadays?
I also want to say that, when we talk about using data, that was awesome, by the way. When we talk about using data to do investing, I think that one thing that we're talking about here is data on the founder. But as anybody who's invested in a company that actually has a product, there's more than the founder. The product exists, right? The founders can leave. We've had many. We've all seen many companies whose founders have swapped out, but the strength of the business is something that tends to continue once it hits a certain point. So then there's this huge area, this big gray area of how do you know if the business is working? Now that problem is actually one that's much more, in many ways, more tractable than the question of, is this founder's personality the right thing, and can I data this thing out? The question of, is this business working? Right, that's a question that we tend to take for granted, right? Most investors, in fact, I sit in a lot of these things, I've chatted with a lot of investors, people tend not to worry about this part too much. It's oh, I know how to analyze a business, I can pick a good product, I'm good at that. That astonishes me because I don't think I'm good at that, and I spent years and years at Facebook trying to figure this out. This is not actually that easy, right? To be able to tell in that gray zone when a product comes out, some users use it, there's something, what's going on, right? Can you figure out using data what's going on there? So that ends up being for instance, where we spend a lot of our time. And when I think about data-driven investing, I think about all of these things, right? There's data around the founder, there's data around how product market fit looks. I've written a bunch of articles about this that people have been using for a while, but there's many different ways in which you can use data to do this stuff. And when I think about the future of data-driven investing, I think of this whole spectrum of stuff, of which founders is a piece of it. And for those investors who believe and who believe and wish to believe that investing in founders is the only thing to do, by all means, that should be the thing they do. But then there will be other investors who think that they really want to invest in businesses, less in founders, and they're looking for great businesses. And then there'll be other founders who are looking for other things. So there's going to be this whole spectrum of stuff in some sense.
So actually, highly anxious founders is actually a predictor of success. So you've got a good portfolio.
So good luck. Because the question for the investors in the room: how many people would want to invest in founders without ever having met them? Does that seem like an attractive model? No hands going up. So I am curious about. So let's take a category there are Cabbage is a company, small business lender. They make loans without really meeting their founders, their businesses. Now it's a whole different model. It's a 1 to 2 year loan. It's a highly digital experience, but you basically go and give them your credit score, some other information about is the business working, right? Highly cash flow driven, and then they'll do some other credit checks and other math on you, and they'll essentially make a loan decision, yes or no, without ever meeting the business owner or having any kind of personal interaction. And they get it right 95% of the time, which for them is pretty good. So their default rate's 5%, and they make money on the rest of it. The equity side of that is very different because there are a lot more variables to crunch. But with the benefit of experience and learnings, and then I'm sure the U.S. will progress differently at a different speed than other parts of the world as far as holding information about private companies and predicting success. Does there ever come a time when private equity investing, maybe at later stages, looks and feels like what Cabbage is trying to do for small business lending?
Yeah, I actually believe that this is probably part of the future, right? Because if you think about what Cabbage does, if you think about the general space of like small business lending, and you think about the number of entrepreneurs which it can affect globally is just dramatically much more, right, than we can affect as venture capitalists. As venture capitalists, we run around, we pick some entrepreneurs, we try to pick good ones. But if you think about sort of, there are just many other financial instruments that can touch so many more entrepreneurs. And if you really, at some deep level, if you really believe that technology is going to have this huge impact, in business, part of that belief probably involves this world where many entrepreneurs across the world can create all sorts of value in some way, that doesn't necessarily need to be a unicorn creating every time. And then the question becomes, well, if your job is really to help entrepreneurs, are you helping entrepreneurs, are you doing the best job for entrepreneurs merely by picking unicorns? Or are you doing a better job for the world by helping all of these other entrepreneurs? Or is there a gray zone in between in which you can do kind of both? And I think that, this is one of the things we think a lot about. It's part of why we have started doing a whole bunch of other things besides just venture investing, because, our job is really to help all entrepreneurs, not just help, the lucky few who happen to be able to, walk onto Sand Hill Road and come from Stanford.
And Gerry, you disagree.
I do disagree.
Tell us
but
why
part
Jonathan's
of what
wrong.
I disagree is, I think if you're going to change the entire system, that may be true. Although it's a bit scary to think that there's an algorithm deciding who gets money and who doesn't, based on your personality. I think, but for me, if you're going to work within the current system, which is more relational than transactional, then you need to meet them. I mean, you need to not only to meet them, but to form a relationship. Yeah, so for me, as a seed investor, and especially a seed investor in New York City and not Silicon Valley, I need to make sure that when the Series A investor comes in, that I'm not going to get squeezed out of my pro rata. And the only way to do that is for the founder to fight for me. So if my founder fights for me and says, no, you know what, you can squeeze everybody else except not Gerry,
Right.
then that's good, right? But if they say, look, hey, sorry, they want 20% of the company, we don't want to sell more than 20%, we have to squeeze you, nobody's getting their pro rata, that's just part of the deal, then I get screwed, right? I can't make money doing that. So I need to have the relationship. I think it's, if we're talking about just picking, I'll listen to the argument about data, but if it goes past picking, then I just don't believe it.
And Amber, what do you think? Is the world of arranged marriages where you're selected to the right VC and the right you're obviously doing a lot of work on researching what is the right investor for for the right company. Do you think how far down the path of automation do you think we go? What is the mix between the human intervention and then what the computer would predict?
So specifically to the matching side, for example, so I would say we've been working with seed, Series A and B startups basically helping them fundraise faster. And our proposition for startups is you will come to us before you even start fundraising, and we will score all the VCs for you and generate this prioritized list of investors who are most likely to be interested in your startup and space, and probably the ones that will have the greatest added value. So that's kind of the work that we've been doing. The results have been very, very interesting because with this exercise, we are usually getting two things. We are seeing the investors of some of our competitors and complementers in our space, and we're also seeing VCs that we never thought of who are very, very relevant. So I do think there is room for algorithms to change how us founders have been approaching fundraising. I mean, we're pretty much doing fundraising just like our great ancestors, those that have been doing this for like the past 10 and 20 years.
Great. Let me see if there are any questions from the audience. Anything you're dying to ask the group? All right, we have a couple of questions that are on the board. Have this one, Jonathan. You want to take the top one about capital?
Absolutely.
Capital as a service.
Sure. On capital as a service, the place where we are focusing on this one, this is not meeting them, right? Actually, this is exactly the situations that we were chatting about over here, which is that we are focusing primarily on the developing world right now, on the emerging markets, where there aren't a lot of investors, specifically in situations where entrepreneurs are actually building really great companies that are growing really quickly, but the investor ecosystems there are somewhat non-existent or they're very thin. In those cases, cases, the data that we're looking for is primarily around understanding product market fit. Sort of the core thesis for this capital as a service program is, can we invest purely on the basis of measuring product market fit? So the first piece of that is, do you believe that you can measure product market fit in a way that's reasonable? And then if you believe that, can you invest purely based on that? So part one, we spent 3 years figuring that out. That was the articles I had referenced earlier. And then part two, can you invest purely based on that? That's in some sense this experiment here, which goes down to, which really comes down to product market fit data, no conversations on the phone. How do we validate how accurate or real that is? That's the secret sauce.
So how do we get that information? I guess we have to invest with the social capital. Is it fair to say it's a matter of time on validating product market fit? Does there come a time when it becomes high degree of probability of success that you can? I mean, you were at Facebook for many years. So you've seen product scale from 0 to 60, hundreds of millions of users, or maybe even billions of active users. Is it reasonable that for where seed and early stage VCs invest, there's a time when it becomes apparent for product market fit, or is it just given the stage of companies, is it typically far beyond our ability to invest, where it really becomes apparent to the data? At what scale does a company have to be at for that to become apparent?
I think we're still trying to figure this out. So when we say product market fit, the way that we approach it, it's kind of like we approach it the way. So if you guys know about like GAAP financials, right? There's this way of organizing your financial information into these statements. Let's say you were in like so this actually, it was like largely invented in the early 20th century, 1920s kind of era. So let's say you were in the early 1920s and you came up with this. You're like, I came up with gross margin. I invented this idea. Awesome. Now you have to, but the thing is, just because you came up with the idea doesn't mean that you should invest based purely on it. That would be kind of scary. It will take you a while to go get a lot of data to figure out what sort of gross margin looks like. Given that this is the gross margin you observe now, what's it going to become later? And we're still in the process of understanding that. Luckily in the current world, there's data everywhere, so we can actually come to conclusions on this stuff much quicker than if we were in the mid-1920s or in the early 20th century, and that's a lot of what we've sort of spent our history on. So the question the original question was, is there a stage at which you can know product market fit for sure? I will rephrase that as, is there a stage at which you can invest in a company purely based on its financial statements? Right. And the answer to that question is, you could, but nobody really knows if that's a great thing to do. There are many stories of investors who came through the 60s, 70s, 80s, fundamentals investors who kind of did that to some extent, and it kind of works. But just because it works for a while doesn't mean it works forever. And it's kind of the same thing here. I don't think we take a very necessarily strong view on that. We take more the viewpoint that it's for us to figure out over time.
Great. Next question. I'll just pick the middle one. I find this interesting. And you guys you've seen the VCs currently on Sand Hill Road and how they're using information, and they probably have different biases or willingness to adopt. To what extent do you think this technology, this trend, is going to be something that they feel threatened by, and to what extent do you think it's something they'll embrace? It clearly doesn't play to their strong suit today, but is it something that you think they will embrace and push? Maybe Aman, you're trying to sell to these organizations. So how do you feel like it's going so far?
Yeah, we're seeing two camps. We're seeing a camp that's basically saying, you know what, we're good. We don't need this data stuff. And the innovator's
dilemma, right? That's what you're fighting.
I guess. They've been doing it so well on their own as a person. Some of the notable names. And yeah, there's just we're good. We don't need anything. And the other camp is they're actually pretty good already, but they're also adopting kind of this strong kind of data focus, and they really do see the value. The most ironic thing for me is talking to an AI investor, or labeled as an AI and data investor, and then them saying, well, actually, we don't think data can solve this problem for us. So that was kind of very ironic for me.
Right. And Gerry, what do you think? You're the establishment. You teach at a Ivy League university, so you're good, right? Or do you think you need some help?
I'm in New York. Somebody asked me last night if there was anything to invest in New York. It's like so yeah, if Sand Hill Road loses their power hold, that's fine with me. But I actually, since I'm not Silicon Valley or Sand Hill Road, I guess I can be the heretic. You know, how many firms are there? There's 2,000 venture firms that are all essentially doing the exact same thing. I mean, what other industry is like that? I mean, who has? You know, there's no real. They're all professional services firms, right? They're all money managers. All they have that makes them different is the people. If somebody says, well, using data will actually give us a permanent advantage, and they're right, then they win, right? So it doesn't matter if the people who decide not to adopt the technology are wrong, then they go out of business. So it doesn't matter what they think.
I think with that, we are out of time. Thank you so much. Great panel, and thank you for spending time with us.